Right, no fluff, let's get straight into it. Morgan, you're the one who's been getting all book smart with the CMT level 3 business. Sounds proper serious. When the big dogs, the institutions, write up their reports to move millions, are they just drawing the same triangles as us, but in a fancier font? Or is there a proper secret sauce?
Secret sauce? You melt. It ain't a secret, that's the whole point. It's a system, a framework. It's not about finding, one magic indicator.
Right.
You lot in crypto just slap an RSI on a 15-minute chart, see it's oversold, and go all in, thinking you're a market wizard.
Oi, don't knock the method. If the price is rocketing, the price is rocketing, innit? Don't need a PhD in 100 different squiggly lines to tell me that. But go on then, smart ass. Impress me. What's chapter 1 in this big book of institutional knowledge?
All right, first up, and you'll hate this because it's not about the Lambo, it's about not having your portfolio repossessed. It's risk management. But not just a simple stop loss. We're talking about designing and backtesting an entire trading system and knowing your statistical risk of ruin.
Risk of ruin? Mate, my whole portfolio is a constant state of risk of ruin. That's what makes it fun. You're not just talking about a stop loss, are you? That's baby stuff.
It's worlds beyond that. It's about systematic position sizing. They use mathematical models like optimal F.
Okay.
To calculate the exact percentage of capital to allocate to a single trade based on its historical win rate and payoff. It means they can take a loss, or 5,
Yeah?
and it's just a paper cut. They've built a fortress around their capital before they even think about attacking.
Okay. So they've got a super nerdy spreadsheet telling them how much to bet. Sounds a bit soul-destroying, but I guess it makes sense if you've got billions. What's next? Get to the juicy bit.
This is where it gets clever. Asset relations, or, clear my throat, intermarket analysis, if you want the proper term.
English, bruv. We're in London, not a lecture hall. Explaining.
It's about seeing the whole board, not just one piece. It's the fundamental idea that no market moves in a vacuum.
Right.
It's knowing that when the US dollar gets stronger, gold usually gets slapped. Or when bond yields are screaming higher, your favorite tech stocks are probably going to get battered. They're not just looking at one chart. They're looking at a whole web of connections that drive the flow of money.
Right. Correlations. I get that. It's like when Bitcoin decides to take a nosedive, the altcoins flow it off the cliff like lemons. And when it pumps, they all try and chase it. It's the BTC dominance dance.
Exactly. But they map it out with precision. They use tools like intermarket analysis, or intermarket analysis, if you want the proper term. They use tools like relative rotation graphs, RRGs. Picture a radar screen. It shows you which assets or sectors are gathering momentum and moving into a leading quadrant, and which ones are losing steam and falling into the lagging quadrant. It's a visual map of money flowing from one area of the market to another.
So you can literally see the capital rotating, say, out of tech and into energy before it's all over the news. Okay, that's a bit tasty. I'll give you that. That's an edge.
It's a massive edge. And then on top of that, they layer on volatility analysis. Now this should be right up your street, Mr. 100x or bust.
Exciting. Now you're talking my language. VIX, baby. When the VIX is high, it's time to buy it. When the VIX is low, look out below. That's poetry, that is.
Sort of. But it's more than just a contrarian signal. Yeah, they use the VIX to measure fear and complacency, but they also use its value to dictate their tactics.
Right.
If the market's going absolutely mental and volatility is high, they use wider stops and smaller position sizes. If it's dead quiet and nothing's happening, they tighten everything up. It's dynamic, not static. They're letting the market's current mood dictate their risk parameters.
Hang on. So that stop loss isn't just a random 2% rule.
No.
It's actually based on how much everyone else is panicking. That's next level. They're weaponizing the market's fear against itself.
You're getting it. And that leads perfectly to the next layer, behavioral finance.
What, are we talking about sitting on the couch and talking about our childhoods? Like, my dad never gave me enough liquidity.
Close. It's the cold, hard acceptance that market participants, us, are irrational muppets. We get euphoric, we panic sell, we chase trends, we get FOMO. Institutions know this, and they chart it. They use tools like the Commitments of Traders report, the COT report. It literally shows you the positions of the huge money, the commercials who use markets to hedge,
Right.
versus the non-commercials or speculators. You mean the dumb money. You said it, not me. But yeah, if the pros who actually produce and use a commodity are going massively long and retail speculators are all shorting it, who are you going to bet on in the long run? They are quantifying and trading based on the predictable psychological mistakes of the herd. That is absolutely savage. Right, let me get this straight. They've built a risk fortress. They're mapping the entire web of assets. They're measuring the market's fear and using it to set their tactics, and they're literally watching the herd to see when we're about to make a stupid emotional decision. That's the one. And only then, Chris, after all of that homework is done, do they pull out the tool that you probably start with.
Let me guess. The actual chart.
The actual chart. The head and shoulders patterns, the flags, the candlestick formations, the trend lines. That is the final piece of the puzzle. It's the confirmation. It's the timing mechanism. The other 4 layers build the high probability case.
Right.
And then
the
chart tells them the precise moment to execute.
So all the stuff we learn on YouTube first, they use dead last. That's completely backwards.
It's the only way that makes sense. You build a robust, multifaceted, evidence-based case for why you should risk capital.
Right.
Then, and only then, do you look for the perfect entry. You don't just spot a bullish engulfing candle and YOLO your rent money into it.
I feel personally attacked right now. So this whole CMT level 3 thing is not a magic formula. It's a recipe, innit? A checklist for building a bulletproof trade argument.
Exactly. A recipe for an institutional-grade report. It's how a portfolio manager can walk into their investment committee and say, here is precisely why we are allocating $100 million to this thesis.
Wow.
We have a 5-layer, data-driven case for it. It's not a punt. It's a calculated, defensible, professional strategy.
I get it. It's about taking the gamble out of gambling. It's impressive, I'll admit, but it sounds like a head of a lot of work. Can a normal retail trader even do this, or is this just for the suits in Canary Wharf?
Encouraging. You can do a simplified version. Anyone can track the VIX. Anyone can pull up a chart of the dollar index next to their gold chart. Anyone can check the COT report for free. And most importantly, anyone can be brutally honest about their own stupid emotional brain getting in the way. You don't need a Bloomberg terminal to stop being a degen.
Oi, there's a not to being a degen, thank you very much. All right, that's a lot to chew on. So to recap the institutional playbook, it's risk, then asset relations, then volatility, then behavior, and then the chart for the trigger. Sorted.
Look at you. You'll be wearing a tie and calling me for my Q3 macro outlook.
Don't you dare put that curse on me. I'm going back to my 5-minute chart for some real action. Right, for everyone listening, if you want to get in on this kind of chat, we're all in a private group. The link's down below. Sign up with our SEXREF link to say thanks for the alpha, then hop in and have a laugh with us. Now, here's a question we'd like you to think about. We've been talking about the multi-layered system the big institutions use to build a case for their trades. So look at your own trading. Are you just a one-trick pony relying on a single indicator, or are you building a real system? What's the one rule in your personal institutional report that you never ever break? Let us know.